On behalf of my fellow partners and directors, I'd like to welcome you all to this morning's Investment and Economic Strategy Review. Regretfully, we are again in webinar format rather than being in face-to-face lunch format. The good news, though, is that we've been able to catch up with so many of you in face-to-face meetings and catch-ups over the last few months, which is a vast improvement from only a few months ago. To those who do not know me, my name is Paul Ashworth and I am the Managing Partner of Cameron Harrison. It is now over 10 years ago that we established Cameron Harrison, but over 25 years ago that with my partners we established and developed the investment philosophy and asset class and allocation strategies that Cameron Harrison so successfully operates now. The Cameron Harrison partners are proud of this nearly three decades of continuous demonstrated performance track record. I presented my first investment and economic strategy review in 1996. Along the way, I've been joined by many chief economists, but today's presenter has been by far the most requested and insightful. So much so, Gerard Minack is today the consulting economist for Cameron Harrison. In the early 2000s, he first presented with me whilst chief economist at ABN AMRO. He then moved to Morgan Stanley as chief strategist. In 2013, he established Minack Advisors and now consults and advises to many of the world's leading financial institutions around the world. I'm grateful that Gerard can join us again today. He's always thought-provoking and challenging and ensures an interesting intellectual consideration of the economic and market landscape. We're also joined by our own David Clark. David is a partner in the firm and oversees our research and investment management division. An engineer by training and background with Rio Tinto and Crew Consulting in London, David brings a strong analytical focus to our investment philosophy and programs. David will discuss our positioning for the times we find ourselves facing and going forward. By way of introduction, we note a current landscape that in many respects looks obvious when we look back in time, especially since the GFC. The surprise is invariably the timing of factors and the direct trigger catalysts. COVID was the X-factor catalyst for a quickening of changes already on foot. This combines with a perceived weakening in the Western liberal world order. The issues are not new, but they have arrived together at the same time. Inflation, China, supply chains, monetary policy effectiveness, Crimea and Ukraine, political polarisation, and electoral apathy. Last week, the Australian federal budget was handed down. It directly reflects the pre- and post-COVID worlds. To be more precise, the pre-COVID world reflects the post-GFC world over the last 12 years and the over-reliance on monetary policy to stimulate economic growth in a world of high savings and ageing populations and diminishing working population. Neither economic growth nor wages responded positively to this stimulatory monetary policy. The term secular stagnation is commonly used to describe this. Fiscal policy remained constrained. This equation was acceptable to households so long as asset prices continued their 25-year upward trajectory. COVID has proved to be the catalyst for government spending to strongly engage. Whilst a direct response to COVID, increased government spending and intervention arguably has its political justification in the post-GFC effects, where lower interest rates have seemingly benefited holders of capital through increases to asset prices, whilst wages growth has been stagnant. There is also a political reality tied up to this increased government spending. The embedded political forces, particularly in Anglo-liberal democracies, have been in stalemate or polarised for some 20 to 25 years. The outcome is a sensitive middle voter and shards on both the left and the right, who will change allegiance on single issues rather than a platform. COVID provided the cover to spend, and spend big governments have. Budget deficit numbers give way to the more ethereal measures, such as deficit as a percentage of GDP, and the objective to reduce this debt over time by growing the economy. The direct costs are huge today, and we have a significant concern for the trajectory of this form of utopian policy, which is not tethered to productivity improvement to truly grow the economy over the long run. This morning, Gerard will share with us his views on this landscape. It is a landscape where the number of risks arising and colliding at this moment in time is significant. There are a number of factors testing our consideration. These range from China's COVID-0 policy, impacting production, shipping, supply chain, maintaining of social stability and resultant inflationary impact, to commodities and weak investment and exploration due to prior capital excesses and ESG considerations. This likewise impacts supply chains, which become susceptible to X factors, to geopolitical conflict and developing world spheres of East and West. In particular, we note that the cybersphere is at the heart of the modern economy. Protecting it will be very expensive and difficult. Australia has arguably been at cyber war with China, Russia and North Korea for some years. This highlights both the different forms of defence spending going forward and its increase as a percentage of GDP. And central banks are seemingly way behind the market curve. With the current yield curve indicating mixed signals, markets are moving aggressively to higher peaks in the Federal Reserve Funds cash rate, to peak nominal interest rates, and they're being higher than the last cycle peak, which reverses the downward slope in bond rates experienced over the last 25 years. And Western liberal democracies continuing to wrestle to re-establish their core values born out of the fires and carnage of World War II and the desire to avoid world war through a new world order. In the meantime, the economic cost through government spending is there to appeal to the powerful marginal voter and may well lead us to a dystopian rather than a utopian future. So this leaves us with the question, does stagnation make way for stagflation? And it's on that note that I'm pleased to welcome and to hand over to Gerard Minnack.
Good morning. Thanks for having me at another Cameron Harrison webinar. I've got quite a chocked agenda for today. There's three things I want to cover off on. The first is a very big picture point. I think the pandemic and I think Mr. Putin have set the precondition for a big change in the structural outlook. Many of the trends of the last 3 decades, basically a declining interest rate structure, I think are going to reverse, and I want to explain why I think that. The second thing I want to focus on is inflation, which is clearly a big concern for policymakers now. And then finally, just talk about the outlook for interest rates. And spoiler alert, I think they're going up, but as I will emphasise repeatedly through this presentation, Australia is not America. I'm going to focus a bit on America, but the situation here is not nearly as dire. So let's kick off. We've really been in a strange 3 or 4 decades. Secular stagnation has been gathering force, and the most important financial hallmark of that is this big decline in interest rates. And this slide is showing the 10-year Treasury yield in the US. And although there's always a cycle, for 4 decades, it's been successively lower lows, lower highs. I think there are 3 reasons why this pattern's going to break, and we could well see interest rates start to trend higher over the next few cycles. The first reason is policymakers have rediscovered the joys of fiscal. We saw massive fiscal intervention in this cycle. This slide is showing you the IMF's estimate of fiscal spending through the pandemic, and it's been enormous. A lot of little labels along the bottom there, but the first thing to highlight is the biggest spender has been the US. They've spent over 25% of their GDP, which is one of the reasons that the American economy has led this global recovery, unlike after the GFC when it was the Chinese economy. Australia's not been too shabby. We haven't done as much, but it's still been sizable. And of course, you can argue that Australia actually rediscovered the joys of fiscal ourselves in the GFC, which is why we were one of the very few countries to avoid a recession in the GFC. The second big change reflects the change in central bank behaviour. Over the last 3 decades, central bank best practice really boiled down to a singular focus on inflation and setting monetary policy on a preemptive basis. Now, that works if central banks have a good model for forecasting inflation. But let me show you what they actually did. This shows the distribution of inflation outcomes in the big 3 Western economies over the last cycle. They're all targeting around 2%, which is that purple vertical. But you can see all the actual inflation outcomes had a big skew to the left. In other words, we gave these people just one job to do, and they blew it. As a result, they're changing their behaviour. Most central banks are now emphasising not just an inflation target, but also aiming to achieve full employment. And most importantly, they're no longer forward-looking. They're starting to set policy based on backward-looking data. You can see the biggest upshot of that in the US, where historically the US central bank, the Federal Reserve, has started to tighten monetary policy as soon as wage growth has started to pick up, as shown in this slide. Well, you can see how different this cycle is. The Fed didn't start to tighten monetary policy until wage growth was running at a 4-decade high. Wow, that's completely unpreemptive. Now, a few times in this presentation, I'm going to slip across to Australia because this is one example where Australia is quite different. The RBA may be a little behind the curve, but this slide shows that the wage situation here is dramatically different. Aside from where we got to in the pandemic, at the lows and the early 90s recession, we have wage growth at the bottom of a multi-decade range, not at the top. And I'll also hasten to add, the RBA has already started to tighten, something that we'll discuss down the track. This changed central bank behaviour has guaranteed an inflation overshoot. This chart shows headline and core inflation in the US. They're both at the highest level since the early 1980s. Once again, we need to underscore the contrast to Australia. Here in Australia, the RBA targets 2 to 3% inflation on average through the cycle, and that's about where underlying inflation is. So we haven't yet had an inflation overshoot in Australia. But this is the second big change, the change in central bank behaviour. There's a third big change that I think will lead to the forces of secular stagnation being overcome. And it's all about the much more bullish outlook for investment spending in most of the developed economies. I'm going to use a lot of the US data here, but a lot of this does also apply to Australia. The first thing we say is that we're going to see a lot more focus on adding resilience to economic systems. We saw with the GFC highlighting the fragility of the financial system. The pandemic has highlighted the fragility of the non-financial system. And the Ukraine war is highlighting geopolitical risks. That means we're going to see more onshoring, more diversification of supplies, and a shift from what has been a just-in-time inventory system to a just-in-case. And that led to this long decline in inventory levels. All these adjustments, adding resilience to systems, is going to require more investment. The second factor pointing to higher capex, and I'm not too happy about this, but it's an obvious upshot of what's happening in Ukraine, is we're going to see an increase in defence spending in the developed economies. After 2 decades of enjoying the peace dividend, we're about to see a rights issue, and this is going up around the world. The third factor pointing to higher capex is climate mitigation. The International Energy Agency has put together an estimate of the capital investment required to hit net zero by 2050. And they're saying that the world will need to invest almost $5 trillion each year in the decade to 2030. Now that compares to global GDP, which is less than $100 trillion. So in other words, this is a spending of over 5% of GDP. An additional factor is an increase in public sector infrastructure spending. We've seen infrastructure spending run down in most developed economies over the last 2 or 3 decades. The blue line in this slide shows spending on public sector infrastructure in the US. It's been at multi-decade lows. That's why the infrastructure is so old. That is why the bridges fall down. That's why the roads are potholed. Fixing this problem is one of the few areas of bipartisanship in the US. They've already passed some legislation to see that increase. We've got an equivalent piece of legislation in Europe, the Next Gen EU program, which is 800 billion euros. Boris Johnson famously is levelling up the UK, which means doing more spending outside London. And we have big infrastructure projects underway in most of the capital cities on the eastern seaboard. The fifth and final factor pointing to higher CapEx, the prospect of higher business investment spending. The remarkable thing about the last 3 decades is that although there's been a cycle in investment spending, in the US at least, and in many other countries, it's been lower lows, lower highs. And that's despite the fact that interest rates have been coming down, profits have been going up, and financial markets have been more than willing to fund expenditure. Now, on this, Australia is absolutely no different. It's little realised just how appalling our investment record's been. This chart shows non-mining investment spending as a share of GDP. Historically, that used to fall to about 8.5% in recessions. For the last decade, it's averaged 8%. Now, why should business investment pick up? Well, I think it's that faster wage growth. If you think about the payoff to corporates undertaking labour-saving investment, it's really a function of wage growth or expected wage growth. And if we have faster through the cycle wage growth, my bet is that we'll see non-mining investment and investment around the world start to pick up. So that means that there are 3 big reasons to think that the big trend in interest rates can change over the next cycle. Firstly, a more aggressive use of fiscal policy. Secondly, the changed behaviour of central banks. And thirdly, that list of reasons that points to higher CapEx on average through the cycle going forward. Now, that's all a structural story. It's why I think interest rates will be heading up over the next few years, in fact, few cycles. But let's zero in on what's the more immediate pressing issue for policymakers and for investors, which is inflation. Yeah. This slide shows headline inflation in the US. It's running at 8%, the highest in 4 decades. The colour coding shows the contributions from various components. The real surprise over the last year or so has been that grey shading, which is the contribution from core goods, that is, goods excluding food and energy. That's been adding almost 3 percentage points to headline inflation. Why is it a surprise? Well, this has almost never contributed a meaningful amount to inflation over the last 2 decades. The red line in this slide shows the level of those core goods prices, and the fact is they've gone up more in the last 20 months than they have in the preceding 20 years. Now, although the Fed has banned the word, I think disinflation is, yes, transitory, and that we can see some relief on this front going forward as we see prices either stabilise or in some cases, I think, decline, which may mean that we'll see headline inflation measures start to moderate over the next 12 months or so. So, does that mean we can sound the all clear? Unfortunately not. This chart is just focused on core US CPI, and that does include that goods component that I mentioned. But as you can hopefully see from this chart, normally core inflation in the US is really just driven by 2 things: shelter and services, which is the green and yellow shading in this slide. And not only does these things normally account for the bulk of inflation, but they're relatively stable. It's impossible to dismiss inflation that's being driven by shelter and services as transitory. So what drives these things? Well, the simple answer is it's wage growth. This chart shows that shelter and service component, i.e. core CPI excluding goods, and compares it to wage growth in the US. You can see the high correlation. With wages now running at 4.5%, the simple point is that inflation will not settle down towards the Fed's inflation target on a sustained basis. The Fed needs to act to soften the labour market to get wages back under control in the US. We don't have the same problem here. The RBA has said that it will not tighten until wage growth is running at a level consistent with its inflation target. Now, the RBA hasn't told us what that sort of wage growth is, but we can have a fair stab at it ourselves. This chart shows the historical relationship between wage growth, which is on the horizontal axis, and the RBA's inflation target on the vertical. And I've marked there the sweet spot. So historically, wage growth of 3 to 3/4%, which you read on the horizontal axis, is typically consistent with inflation running at 2 to 3% on the vertical, which is what the RBA is aiming to achieve. Where are we now? Well, current wage growth is less than 2.5%. So unlike in the US, where wage growth, I would argue, is clearly running at levels incompatible with the Fed's inflation target, that's not the problem yet in Australia. Now, I say that because there are some leading indicators of wages that are pointing to quite a sharp acceleration in coming quarters, so I acknowledge that. This is one of the most aggressive lead indicators. It's from the quarterly NAB business survey, the blue line, where we ask businesses, how fast do you think wages are going up, or labour costs? Historically, that's been a fairly good lead, so that is saying that wages will increase in the next 2 or 3 quarters, which is why I and most other people think that the RBA will start to increase interest rates in the second half of the year. But that gets to the big question: how high may rates go? Well, the answer is going to depend on where we're looking. So let's start at what the market's forecasting for the US. So the red line here is the latest market forecast for the Fed funds rate, which is the key policy rate in the US. Those purple dots are what the Fed members themselves are forecasting. So the peak is not dissimilar, but the market's expecting that the Fed will have to go sooner than they've been forecasting. And I have to say, some recent comments from Fed officials suggest those dots are too behind the curve, and there's a suggestion that the Fed may even tighten in 50 basis point increments, that is half a percentage point increments, at the next meeting, or potentially 2. So we've got this peak in the Fed fund rate at a little under 3%. Now it's worth looking at what the market is forecasting for US inflation, which is the green line here. Now, on a medium-term view, this is quite comforting. The market's anticipating a glide path back to around about 2.5% CPI. The Fed actually targets a slightly different measure of inflation, and that 2.5% CPI outcome would be consistent with the Fed hitting their actual inflation target. But in the near term, the market's looking at inflation running at 4 to 5%. So that means when the market's saying the Fed will push its nominal interest rate towards 3%, that's consistent with the interest rate still being negative in real terms, that is, below the current inflation rate. Now that's consistent with the big picture trend that we saw unfold when the world was in the grip of this secular stagnation. And as I mentioned at the outset, the most important financial hallmark of secular stagnation was the trend decline in interest rates. This chart is showing you the real Fed fund rate. It's designed to highlight the cycle peaks And you can see since the early 1980s, each peak has been a reasonable distance below the prior peak. So we've seen this stepping down. And effectively what the market is saying is that this pattern will continue and we won't even get the Fed fund rate back to positive territory in this cycle. Well, this is where I think the market is too pessimistic about the economy and is therefore underestimating how high rates will need to go. I go back to those reasons I gave you why the forces for secular stagnation are weakening. I think the US economy will be better able to cope with rising rates than the market gives it credit for. And the key really is the good health of the US consumer. The consumer is in as good a shape as it's been for, I would argue, 2 or 3 decades. The blue line in this slide shows that the US consumer has actually delevered. So debt to income levels have come down. I mean, they did it by defaulting, but that's deleveraging. And the red line shows interest payments relative to income, which is at multi-decade lows. Wage income is exceptionally strong. And for the average American, they don't receive interest payments. They don't receive dividend checks. This is their bread and butter. So wage growth of just over 4% sounds good, but if you take into account how many more people are working and how many extra hours they're working, aggregate labour income through last year was rising at 9%. Wow. Even with very high inflation, that translated into 3% real. Now, consumer spending accounts for 70% of US GDP. So if consumer spending keeps on rising at that real rate, 3%, that's going to add 2 percentage points to US GDP. That's almost above most estimates of what potential US GDP growth is. So put very simply, if US consumers just increase their spending in line with their labour income, I don't need any contribution from anywhere else in the economy, and I've got an economy that's running probably too hot. But I think there will be contributions from other things, and I'd highlight in particular the outlook for business investment. The blue line here is business investment in the States. The red line is an average of all the surveys where they ask businesses how much they plan to invest, and that's staying at very elevated levels. So I'm relatively upbeat on the outlook for business investment spending. So with those 2 points, strong consumer, strong business, I think that the peak in rates this cycle will be higher than what the market's anticipating. I think the Fed will need to push its policy rate towards 4%, which I think is very likely to mean that we see in real terms a positive rate. So quite different to what the market is forecasting. So in the US at least, I think the risk on the next couple of years is that we get surprised at how high interest rates go. What about Australia? Well, let's have a look at what the rate market's forecasting here. And wow, a peak at 3.5%. So the US, the peak was less than 3%. In Australia, the market's saying that the RBA will ultimately need to push its cash rate target to a level above what the market's anticipating that the Fed will need to do in the US. Now, I find this forecast puzzling. Puzzling both in the sense that the market expects that the RBA will do more than the Fed, but even puzzling as to the absolute level of rates in Australia. And why am I puzzled? Well, I've already mentioned some of the reasons. We've got an RBA that has not let wages get out of control. We've got an inflation that's within its target band in contrast to the US, where it's at 4-decade highs. And the RBA has already actually started to tighten. We've got to remember that in this cycle, unlike in most cycles, the RBA didn't just work to control the overnight cash rate, which is the rate that banks lend each other overnight, which is the cash rate target in this slide. The RBA also moved to control the 3-year rate, which is the red line in this slide. Why did the RBA try to control that and did successfully control it at very low levels for a couple of years? because this is the rate that most banks use to price their fixed rate mortgages. And this achieved a dramatic reduction in the fixed rate mortgage to what was all-time lows. But last November, the RBA gave up on this, and you can see the dramatic increase in the 3-year yield, the red line, and as a result, that's lifted the fixed rate mortgage by almost 1.5 percentage points. That blue line's monthly data, that blue line's almost certain to have headed higher in March. We don't have March data yet. So the first point to note why the RBA won't need to be as aggressive as what the market's pricing is it's already made a big step towards tightening conditions. But the next point is to realise that the RBA arguably has the most powerful monetary policy lever in the Western world. What gives its policy lever such power? Well, a couple of things. The first is, ironically, Australians have got so much debt. And obviously the impact of an increase in rates depends on how much you've borrowed. So this slide just compares household debt relative to income in Australia and America. And as I mentioned earlier, Americans have actually reduced their leverage and it's now sitting below 100% of their income. Whereas in Australia, we've kept on pushing it up and we're pushing it towards 200% of income. The second thing is the debt burden in Australia is a lot higher than in America. Now, you may have seen some charts that show that the debt service burden is actually quite low. And if you're only looking at interest payments, that's actually accurate. But my experience is that most banks expect their loans to be repaid. And what this chart does, it compares the total debt burden. That is the principal and interest repayments. And I've done it for both the US and Australia. So we've got a significantly larger debt burden. And what's interesting here is our debt burden on this basis, yes, it is back down to levels seen 15 years ago, but this is with interest rates at all-time lows. So that blue line's only got one way to go, and that's up. The third reason the RBA has such a powerful monetary policy lever is the nature of the debt and how quickly a change in the policy rate feeds into the rates that Aussies actually pay. Now in America, the bulk of household debt is mortgage debt and the bulk of mortgage debt is fixed rate debt. So if the Fed changes its Fed funds target, it has very little near-term impact on the rates that people actually pay. In Australia, the bulk of housing debt is also mortgage debt, but the bulk of mortgage debt in Australia is floating rate and it's priced off the short end. So the idea that there's long and variable monetary policy lags, well, in Australia, it's 5 working days. If the RBA increases the cash rate target on the first Tuesday of a month, commercial banks will feed that into the mortgage rates we actually pay the following Monday. And this slide shows that quick feed through. The red line is the RBA cash rate target. The yellow line is the standard variable mortgage rate charged by the big banks. And the blue line is the actual interest rate that households pay. That's quarterly data, so it's a bit smooth, but trust me, it feeds through very quickly. The bottom line is the RBA will not need to lift interest rates as much as markets are assuming to slow growth down and get inflation back towards its target band. And I think it's very unlikely that the RBA will be tightening more than the Federal Reserve in the US. So with that, let me leave you with four key points. The first is, I think we're seeing a major trend break. The curtain's coming down on secular stagnation. That's because we're seeing fiscal policy, because we're going to see higher capex. But as this chart shows, we've seen a dramatic change in the way central banks are behaving, and that points to higher wages and higher interest rates on average through the cycle. The second point is the US has got a real inflation problem. Yes, there may be some temporary slackening in inflation later this year as some of the one-off price increases reverse, but ultimately wages are the key to core inflation, and wage growth in the US is already running at levels incompatible with the Fed's inflation target. That means in turn that I think the market's wrong to assume that interest rates will continue this long-term trend decline. The market's assuming that the real rate will not get above zero in this cycle. I think it will. But it's not a read through to Australia. Australia is quite different to America. Australia is much more sensitive to rising rates, and Australia does not have the same inflation problem as America. With that, I will hand it back to the team at Cameron Harrison. Take care.
Thanks, Gerard. Whether secular stagnation has been reversed, time will tell. What is clear is that governments, unbridled in their spending, will significantly contribute to reversing this trend. It gives me great pleasure to introduce David Clark to outline how Cameron Harrison has and is addressing these significant factors in our investment strategy settings.
Thank you, Paul, and thank you, Gerard. We've covered a lot of content so far in today's webinar. So what I want to focus on for the final 5 minutes is a brief recap of the key trends that are feeding into Cameron Harrison's outlook, and then to dive more deeply into the investment implications. The first point to make is we believe that the economic and investment landscape is undergoing a period of significant transition, as is often the case following an economic crisis, or in this case, a health crisis that has caused an economic response. In the aftermath of the GFC, government swung quickly away from fiscal stimulus towards budget repair. In Australia, these years were captured under the Abbott administration and their failed attempts to pass spending cuts through the Senate and the budget repair levy. Ultimately, this led to lower economic growth, lower inflation, and lower bond yields. This time round, politicians are not keen to repeat the same austerity approach, and it would be fair to say that there is limited appetite both domestically and around the world for austerity. Instead, spending is likely to remain structurally higher. Now, this is a very significant change that seeks to counteract the demographic forces of secular stagnation. This change is even enough to turn a famous perma bear like Gerard into something that sounded a lot more like a bull. For Cameron Harrison, we view the decade ahead to be characterised by a shift from deflation to inflation, globalisation to isolation, monetary to fiscal excess, and a free market approach to a populist interventional approach. This will have implication across all the key asset classes of bonds, equities, and commercial property. The key theme for bonds is a transition from supply-side goods inflation to demand and wages-driven inflation. The current goods inflation, which is shown in the grey line below, is highly unusual. After 20 years of averaging approximately zero, it is now at 12.4%, the highest since March 1975. Our view is that this is a short-term pandemic-driven shift, and it will eventually dissipate and return nearer to historic levels. On the other hand, the growth in services inflation, shown by the green line, is wages driven, and this normally will last longer. Ultimately, we see this feeding into bond yields in the 3 to 4% range, notably higher than current market forecasts. Given the rising rate environment, our interest-bearing portfolio is underweight government and other high duration bonds, which will incur a negative capital movement as rates rise. We also have concerns over global corporate credit. Nearly half the outstanding stock of corporate credit in the US was issued in the last 2 years and will need to be refinanced in the future into a less liquid market. On the flip side, we are overweight floating rate financial and corporate bonds. The return on floating rate bonds increases as interest rates go up, and they do not lose their capital value in the same way that fixed bonds do. We also remain positive on residential mortgage-backed securities, particularly those with seasoning pre-2021. That is, mortgages that were issued either before or in the early stages of the pandemic and benefit from the uplift in capital values that have occurred over the past 18 months. Turning now to equities. To have a widespread bear market or a correction in equity markets, this normally requires a recession. We believe that a recession is highly unlikely in the year ahead due to the large amounts of fiscal stimulus that are still working their way through the bank accounts of households and corporates. We expect investment from both government and private sectors to be higher going forward, and as we saw in the budget on Tuesday night, this means structural deficits for spending on infrastructure, energy and defence. In this environment, it appears likely that there will be a rotation away from previously fancied sectors like communication services and non-industrial technology towards more cyclical sectors like industrials, metals, materials and logistics, sectors that can grow earnings faster than the wider economy. We also maintain our overweight positions in health and agriculture. Both these sectors offer strong inflation defensive characteristics that are helpful to our portfolio. Finally, looking at commercial property, which is still trying to find its post-pandemic normal. The key theme in office has been a flight to higher quality office buildings or a shift to the city's fringes. In Melbourne, this has seen a significant tightening in vacancy rates at the Paris end of the city compared to the rest of the CBD. Our view is that we think office will regain most or the majority of its importance to the workforce and expect to see margins tighten from the current high levels. However, we're cautious on lower quality stock in the CBD and prefer fringe CBD office buildings or co-located industrial office. Industrial property has been one of the big beneficiaries of the pandemic and should continue to benefit from additional demand as corporates resort to further onshoring of inventory in order to insulate their supply chains from further disruptions. On the supply side, the cost of land and construction has jumped considerably from pre-pandemic levels. This has slowed the pipeline for new developments, further adding to the supply-demand imbalance. The combined impact of this should see further tightening in yields. In the retail sector of the market, the shift to online shopping is not something that we expect to unwind, as it represents an acceleration of a pre-existing trend. Some sectors will be largely immune to this in the short term, supermarkets and chemists being two examples, and we have recently added to our investment in both these areas. It should be noted that we continue to have no meaningful exposure to retail shopping centres. As a final takeaway, yes, there have been significant changes in fiscal and monetary policy, as well as a rise in geopolitical tensions. But there are many things that remain the same, and these are the focus of our bottom-up approach. Firstly, quality management teams with good systems, a clear focus, and a well-communicated strategy will continue to outperform their peers. Secondly, in a shifting landscape, quality firms with robust balance sheets and margins have more time to adapt and flexibility to adapt to the changes in the economic environment. And finally, as this cycle evolves, we will see the added importance of dynamic asset allocation to respond to changes and opportunities in the market. With that, I'll hand back over to Paul, as I believe we have some questions for our Q&A session.
Thanks, David, and thanks, Gerard. There's a lot of highly considered discussion and points, that have been highlighted, and what are clearly very significant changing times. Certainly, what's clear, however, is that there are some fundamental differences between Australia and the US, and investors need to be mindful of those differences in the investment approach. Just on a matter of housekeeping, we'll be shortly sending through the presentation and keynote summary to attendees. But also today, I encourage you to use the question button and put questions to David, myself, and Gerard. And I note that a few of you have already found the button, and we have some questions. The first one's for David, and that is it's Australian focus. Do you see interest rates rising faster than expected? But importantly, how do you think this will affect property and Australian REITs or listed investment property trusts?
Oh, thanks, Paul. So probably two parts to that. First, interest rates and then the impacts. So as Jared noted in his presentation, we tend to agree, yes, there's an inflation issue over in the US, but that issue in Australia hasn't quite materialised yet. And the key reason for that is wages growth in Australia hasn't exploded like it has in the States, and we don't expect that to happen here, principally because in Australia at all levels of government, federal, state, even council levels, there's a pro-immigration stance. So we expect to see a whole lot of labour supply coming in over the next 12 to 18 months. Just yesterday we saw that 40,000 working visas were approved for Australia. Compare that, that's an annualised rate of 480,000 a year versus a target of 160,000. So there's going to be a catch-up in labour supply that will keep wages growth lower than it is in other developed countries. And as a result, we actually think the markets are too hawkish. They're expecting rates to go up too quickly in Australia. In terms of property, I'll start with commercial properties or industrial property. We actually still remain pretty positive on that side of things. Rising rates in terms of industrial property will make it even more difficult for new stock to come online. So you have a further worsening of that supply-demand imbalance, which should support yields. If inflation was to rise quite a lot, the other characteristic of industrial and commercial property is that most of the rents are tied to inflation. So the majority of rents will be CPI plus X%. So they actually behave more like an inflation-linked bond rather than a fixed bond or government bond. So we expect valuations to be maintained. For everyone's biggest asset, or generally the biggest asset, their family home, tightening rates is usually not a good thing for property, and a slower wage growth dampens the ability for households to raise deposits and fund mortgages. So I think we don't see the bottom falling out of that residential housing market, but more just sideways movement in line with inflation. So a lack of real growth for the foreseeable future.
Great. There was just a follow-on question to that. In particular, what underpins your positive stance on industrial property?
Sure. So, the first one was that we think demand is going up. There's been shocks to supply chains through COVID, the Ukraine war. So companies are naturally looking to hold more inventory. People are buying more products online, so they need to have better supply chains in Australia for that. So there's demand side there. On the supply side, what we've seen in our conversations with people in the industry is both construction costs. So there's the labour for construction costs, but also the materials have gone up quite a lot. But particularly the land costs to build these new sites has gone through the roof. So that's making supply really difficult to come online. It's shifting out the pipeline of new developments. And so we think that will be supportive for current stock in the market.
Great. Jared, you're not off the hook. Jared, what is your medium-term view on China's growth profile as this directly impacts Australia's national income and prospects?
I could talk a whole hour on that. Look, the short answer is Chinese trend growth is clearly decelerating, and it's worth noting that although China's impact on the global economy in the last 2 or 3 decades has obviously been enormous, there have been economies that have followed the path that China's walking on now before. And there's 2 particularly, I think, illuminating examples of Asian countries that have done what China did, which is Korea, South Korea and Japan. both of them enjoyed very fast growth like China has for a number of decades. But then as they hit middle income levels, their trend growth slowed quite precipitously. And it's quite interesting to observe that China is following that pattern. So my hunch is that Chinese growth within 2 or 3 years, we'll be talking about 3 to 4% Chinese GDP growth as the new normal. And indeed, we've already had to cut down our estimate of what is normal Chinese growth. I mean, pre-GFC, China routinely grew at double digits. A single-digit GDP growth year was considered a bad year for China. Since then, it's been ratcheted down. Now the view is it's 5 to 6% is normal, and that what is normal is going to continue to decline. Now, that ostensibly could affect Australia. What's interesting is it hasn't so far because there's a few moving parts. And although China was very important from a number of our commodity markets, it wasn't the only influence and won't be the only influence going forward. And I'd highlight two countervailing forces that could mean that Australia enjoys relatively high commodity prices for some time. The first is one that I alluded to in the presentation, which is I think the demand for stuff is going to remain quite strong. And this is the rise of CapEx for all the reasons I explained. And that's going to put an underpinning beneath the price of certain commodities. The other part to why I'm relatively upbeat is the supply side. What we are seeing so far is fantastic supply side discipline by commodity producers. And that's really for two reasons. One is the ESG overlay. Energy companies are very reluctant to undertake major oil projects that may have 30 or 40 year lifespans if they think, well, I'm not going to be able to sell this in 30 or 40 years' time. But even mining companies, almost every mining company CEO still has the scars of the last cycle. And just to remind what happened last cycle, obviously we had a China boom, but we had an even bigger CapEx boom. And the massive increases in capacity just came on stream after the GFC as really the bottom fell out of the global growth cycle. Return on assets got destroyed in the industry globally. ROAs actually went negative. So the industry, on average, lost money. It's now better. In fact, ROAs are back almost at record levels. But every CEO, CFO remembers that disaster of the last cycle, and they're now very reluctant to expand supply. So the answer to the question is, yes, China's growth is going to slow and slow quite dramatically, which is continuing the pattern that we've already seen over the last 10 years. How will that impact Australia? It may not be as bad as you may think, because as I said, there are other reasons why I think demand for commodities will go up, and we're seeing an unusual degree of supply side discipline by producers.
Great. This is a question for David, and it's in terms of inflation and equities. And that is, what are the type of companies that you are focusing on and see, appropriate pricing power to maintain, if not grow their margins in an inflation environment?
Yeah, so good question. So the key in an inflationary environment in terms of equities is almost the answers in the question there is pricing power. So if we look at it in terms of sectors, companies like staples or supermarkets that can easily pass on the increases in their cost of goods sold to consumers, they will do quite well. In a similar way, healthcare providers are an essential service in a way, so they're able to pass on the additional costs. And at the other end of the spectrum, if you're very close to where inflation is occurring, so if you're a commodities producer or industrial metals or in that part of the sector, then you're very easily able to pass that on through the market mechanism to your consumers. So the key bit is being able to pass on whatever price increases you have in your cost of goods sold through to your consumer immediately.
Great. Question for Gerard, which really goes to your two slides on market expectations in the US and Australia for the cash rate, respectively. You profit an upper limit in the US. The question is, for Australia, with the extent of household debt burden in Australia, what do you think the RBA's cash rate ceiling is?
Well, yes, the US, I put it around 4%. I think ours is lower. I think 3% would probably be enough to put a significant brake on growth here. But look, I've got to flag a couple of things. Every forecast at the moment is subject to two large and obvious risks, which is what's happening in Ukraine and the still lingering effects of the pandemic. And there's an idiosyncratic risk in Australia that I think matters if you're going to try and judge where policy may need to be on a 2 or 3 year time horizon. David actually alluded to it, which is migration flows. I did show a chart that had a leading indicator for wages, and it was going virtually vertical. I mean, that's because we've got a real pressure cooker labour market at the moment with the legacy of borders being closed for 2 years. We're now in the process of reopening the borders, and I think one of the biggest uncertainties in the Australian outlook is just how far those borders are opened. And also, to a certain extent, we may throw the borders open and find not as many people come, because I doubt very much that we'll get Chinese students, Chinese tourists back in the same numbers we had pre-pandemic. But there may also be some legacy issues given the way we treated some of the people here who weren't eligible for JobKeeper, weren't eligible for any social security, and found it very difficult to get home. So they may not be coming rushing back either. But it's the single biggest uncertainty, because I think when we look at the policy approach in Australia, and it's quite right, I guess, normally to focus on interest rates alone, but effectively the migration numbers are a huge policy lever now. And if we get labour supply quickly returning to the labour market, then I agree with something David said, which is that will take the sizzle out of the labour market, and I'd imagine take it out fairly quickly.
Yeah, I suppose just as a joiner to that, our view is that both sides of politics, perhaps for some slightly differing reasons, do support higher immigration going forward as a means to generate nominal economic growth. It has proven over the last 10 years to be, together with something they're not in control of, which is commodity prices, is about singularly the only way that they've been able to grow the economy, but at the expense of GDP per capita and wages growth. So I think yesterday we saw the monthly figures for visa issuance in February, and they were pretty robust figures. So even though we're going into winter, maybe some people do want to come and see us down under. So, but yeah, we would very much agree with Jared's point there. Well, on that note, that's the conclusion of our questions. I want to again thank Jared and David for their wonderful contributions and thought-provoking commentary today. We'd like to thank you for your support and attendance. Of course, if you've got any further queries or questions, please reach out and contact us. We wish you well. We hope to see you face to face for lunch for our, which is our traditional approach, for our next investment and economic strategy update. So again, thank you all.